Your mortgage payment? A medieval peasant would understand it instantly. Because the system you're paying into today is built on the exact same blueprint that kept serfs tied to land they'd never own. And yes, you should be pissed about that. Let's get this straight. For the first years of your mortgage, you're not buying a house. You're renting money. Take a $300,000 mortgage at 7%. Month 1, you pay $1,995. Only $245 builds ownership. The bank pockets the other $1,750 as pure interest. 5 years in, you sent them around $120,000 and only shaved about $15,000 off the actual loan. This lopsided payment structure isn't an accident. It's a centuries-old tactic. Back in medieval Europe, peasants never owned land. They paid yearly dues to the local lord just for the right to use it. Work your entire life, make every payment, die, and you still owned nothing. Your kids inherited the obligation, not the property. Then in the 1400s and 1500s, Italian merchants and Dutch financiers innovated something new. A repayment structure where the lender gets paid first. Interest upfront, principal later. Borrowers felt like they were making progress when they weren't. This became amortization, and it changed everything. By the 1700s, European banks perfected this model. Long-term loans, predictable payments, and a structure where the borrower stays in debt for decades, while the lender gets guaranteed profit. Today, it's the same system with better branding. Your mortgage is a 30-year contract designed to secure one thing above all: the bank's safety. They get interest first. They take your house if you miss enough payments. They profit whether you stay, leave, refinance, or sell. That $300,000 house, at 7% over 30 years, you'll pay over $700,000 total. $418,000 of that is interest. You didn't buy a $300,000 home. You bought a 30-year revenue stream for a lender. And you were told it was the path to wealth. Why hasn't the system changed? Because everyone benefits except the borrower. Banks want decades of predictable cash flow. Governments want rising home prices and property taxes. Real estate wants constant appreciation. Investors want mortgages bundled as securities. Who doesn't benefit? The person making the payments. Shorter loans? Front-loaded principal? Fairer structures? Those would destroy bank profits and destabilize the industry, so they never make it past the discussion stage. Here's what your mortgage actually is: a structured, long-term debt obligation built on the medieval model, where you pay for years before you actually own anything. Serfs pay dues to stay on land they didn't own. Homeowners make payments for years before they finally gain real equity. Different era. Same logic. You sign away decades of future income. The lender takes their cut first, and only at the end, if everything goes perfectly, do you finally own the thing you've been paying for all along. I'm not telling you not to buy a house. I'm telling you to see the system clearly. Your mortgage isn't modern. It's a medieval repayment strategy with nicer fonts and cleaner paperwork. And once you understand the architecture behind it, you'll never look at that monthly payment the same way again.